Hello, I'm Mark Apsey, Head of Indexing at thematic Research, and welcome to the week ahead. Before we get into this week, let's actually take a little recap of the past quarter. Turns out Friday was the end of the quarter, so why not take a look at it? All right, so when we look at broad equity indexes, and I'm not going to go blow for blow, so don't worry. But we started out the quarter, April. Everything traded off about 5 or so percent. Small caps, of course, had to outdo everybody. They were down around 7 to 8%. Uh, May started. Everyone's riding high on Fed rate cut expectations. That was great, right? We saw Dow 40,000. We saw SPX hit new highs. Everybody was going to the moon. And then the Fed came out and said, yeah, maybe we won't be cutting as aggressively. In fact, if things look bad, we may even raise rates. And then, of course, everything traded off again. Now, what was interesting is that as the rest of the market was responding to those Fed comments, right, tech, specifically AI tech, it kind of picked up the ball and ran. And so what you ultimately saw through the end of the quarter was that the more tech exposure you had, the better you did, right? And that's best exemplified just by running through the numbers, right? So by the end of the quarter, the Russell 2000 did make up some of the ground it lost at the end of April, but it was still down about 3.6%. The Dow, of course, off about 1.75%. And then here comes the tech exposure I was talking about. SPX up just under 4%. And then the NASDAQ composite up about 8.3, 8.4%. Now, what's interesting to me too is that when you look at Qs, right, or NDX, right, which is the NASDAQ 100, that actually underperformed the composite. So, to me, that speaks to a little bit more participation in broader technology as well. So that actually was good to see. And even if you look on the S&P side, the Technology Select Spider fund, that was up about 8.6 as well. And clearly was the leader in the quarter. I mean, I think if I look at these communication services, tech, utilities, and staples, I think were the only positive select sectors up this quarter. So clearly there's a little bit of pain going on. When we look at our targeted exposure portfolios, some people may refer to them as thematic models. The thematic name, unfortunately, has picked up kind of a bad reputation, mostly due to what I like to consider kind of poor product design by a number of index and ETF issuers. So in order not to kind of paint our models with that same brush, we'd like to refer to them as targeted exposure models. Now, one of the things we like to talk about with our models and with what people call thematics is that when they're done correctly, they really should bring to life those alpha producing portions of broader sector indices and, of course, broad equity indices as well. And, for the most part, we kind of saw that this past quarter, right? Our own AI model up 8.82%. Our CHIPS Act model up 8.66%. And it should be noted that our CHIPS Act model is not, NVIDIA, AMD, and Intel. We're actually looking at those companies that are going to be the ultimate beneficiaries of these mandated dollars going into fab development and those kinds of things. Another of our models which did well this quarter, and it was a little bit of a surprise, but actually the space economy model, right? And that's one that if you follow that sector, the last couple of years honestly hasn't really been that good for that sector. However, we did see news that both Verizon and AT&T are looking to provide kind of regular way satellite service to their customers, and there was a component in our model, I believe it was AST Space Mobile, who they contracted with to look to provide these services. And it's interesting because in as much as Apple made noise or kind of a splash with their satellite SOS calling a couple of years ago when they launched the 15, This is service that the carriers are now saying that they want to provide at any time and not just in emergency situations. So, some deserved price pops there. Um, Aging of the population was another model. It didn't shoot out the lights, but it did outperform the S&P 500. And of course, a model that we've talked about in the past and undoubtedly will continue to talk about is our nuclear energy and uranium model that had a very strong quarter, up about a little over 14%. And that's just one that honestly, when you look at the space, especially within the scope of renewables, it's just something that makes sense. You know, um, I think I've talked about that in the past. I'm not gonna kind of go down any other rabbit holes there. Um, so when we look at the last quarter again, tech was the name of the game, um, and honestly, it came down to what people are thinking about what the Fed is going to do, right? And that is not so much about what the Fed is going to do, but their reaction to data as it comes out, right? So looking ahead to this week, it's a pretty data-heavy week. Um, we have PMI figures coming out, manufacturing on Monday, services on Thursday, right? And we have both vendors of that, which are ISM and market, S&P Global / market. And just very briefly at high level, there are two different vendors. They have two different methodologies. And the kind of takeaway points from those methodologies is that the S&P / market figure really does focus solely on the U.S. And in fact, when they survey their respondents, they tell them, please respond only with regard to U.S. operations. ISM says, talk to us about your company as a whole. So if they're surveying multinationals, they will get feedback from whatever regions that company is in. Another thing which is a little different too is that in their methodology, ISM is looking for not just specific roles in which to ask these questions, but their respondents must have a particular title. So if you're a large multinational corporation, now you most likely have somebody who's, the global head of the Americas and whatever. But the point is that you have that person with that title. Smaller and kind of mid-sized companies might not have that. So what you end up having is that S&P Global market data comes out to be, a lot more U.S. centric, and by some measures, a lot more inclusive as to the breadth of companies that it is surveying, right? So that's just something to think about as these numbers come out. Friday, of course, we're getting an unemployment update. We're getting payrolls. We're getting unemployment. Now, one other side note about that. So the Bureau of Labor Statistics actually has 6 distinct levels of how they measure unemployment. The one that's labeled U3 is the one which is listed as the official unemployment rate, right? And that is just the total unemployed as a percentage of the civilian labor force, right? And they come up with that number. There is a broader number, well, there's a couple of broader numbers, but the broadest one that they have is labeled U6. And it consists of U3, which is total unemployed, plus what they call all persons marginally attached to the labor force, which also, and this is what I like about it, includes discouraged workers, right? So discouraged workers are part of that. So it's just a broader number, right? And then as well, it also includes plus total employed part-time, as they describe, quote, for economic reasons. Okay, so U6, a much broader measure, and it's interesting. I ran a very quick study, 30 years of monthly data, came up with an average spread between those numbers of 4.51%, right? And my thinking is that kind of the broader the number, the more kind of non-full-time workers there are in the economy. And when I look at this over time, there's been spreads as much as 7, 8, 9, 10% in some time periods. But when I look at it now, that spread is actually below the 30-year average. It's at 3.4% again compared to that 4.5. So, long and short of it for me is that, people who want to work can find work and are working. Okay. Now, um, the issue of how much they're getting paid and what their expenses are is kind of aside from that. But, you know, from an employment perspective, I don't know that I see, again, cause for, imminent rate cuts. Now, if you think about Walgreens earnings that came out, and to a certain extent Nike's earnings that came out, the following day, clearly, I mean, if Walgreens is looking at, potential weakness in the consumer, that's one thing. Nike mirroring that, but also throwing in China. Frankly, I don't know that anyone should have been too surprised about China and potential weakness there. Um, you know, that is one thing. Honestly, it would be a little different if, Walmart came out and had those same comments. Now, Target, Walmart, other kind of big box chain stores have kind of danced around or touched on um, consumer weakness, but not to the extent that Walgreens did. And it'd be interesting to see, in this next round of earnings coming up in July and August, um, the Q2 earnings cycle, if what Walgreens talked about becomes a pervasive theme, right? Um, so with that, of course, ties in the discussion of um, rates and the Fed and all that kind of stuff. And I'll just dip back a little into the quarter to say that when you look at the Fed funds curve, um, basically there was an entire shift of the curve down about 25 basis points between the beginning and end of the quarter. And with that, um, odds of rate cuts being pushed out further, right? So at Friday, um, for the July 31st meeting, there's just under a 10% chance of a rate cut is priced into the curve right now. However, when you look out to September's meeting, that figure rises to just under 60%. So not a slam dunk, but certainly trending towards looking at that. When you look further out into the curve and what's priced in, there's basically I think it's something like 80 or 85% chance of at least one cut by December, right? And frankly, there's been a lot of folks talking about how the Fed is going to try to avoid the time period around the election and pretty much after the election. If they feel it's time to do something, they will do it. One other thing about the Fed and kind of preemptive moves. I mean, if you look at the last 4 easing cycles, it was only until there were at least 2 or 3 rooms of the house on fire, right? The Fed does not act preemptively. They are reactive because, and as they've said themselves, they would rather, fix them overshooting a rate than causing some kind of cascade effect on the economy by being too aggressive in either cutting or raising. So let's not forget that this isn't like a trading desk that has more capital to throw at a trader. They're being cautious and conservative about what they're doing and kind of where and how they're doing it. So honestly, I think that's about it. Like I said, a data-heavy week. Manufacturing PMI Monday, services PMI Wednesday, unemployment update on Friday. Of course, within the PMI numbers themselves, prices paid, right? Prices paid is going to be a big thing people are going to look at, and again, try and gauge what the Fed is going to do, if it's going to do anything at all. So, have a great week, and thanks for tuning in.